And I think specifically what we're looking at and how do we solve these big questions, that really doesn't work with sound bites. These are very, very big challenges that need very smart people to kind of tease things out and deduce things, and kind of open source their brains to the world. That's really what Smarter Markets is about.
Welcome to Smarter Markets, a weekly podcast featuring the icons and entrepreneurs of technology, commodities and finance, ranting on the inadequacies of our systems and riffing on ideas for how to solve them. Together, we examine the questions, are we facing a crisis of information or a crisis of trust? And will building smarter markets be the antidote?
This week on What Are Smarter Markets, we dive into the heart of the matter with Josh Crumb, the founder and CEO of Abaxx Technologies. Josh and I will discuss his Smart Markets vision for how technology can be leveraged to redesign and improve markets to meet society's biggest challenges, including climate change and the energy transition.
Well, joining me now is a man who needs no introduction, and that is Josh Crumb, the founder of Abaxx and Smarter Markets. Josh, mate, it's always a pleasure to speak to you. How are you doing?
Thanks, Grant. And thanks for being part of this conversation to kick off the year.
Oh, look, I'm delighted to be a part of it. There's so much I can learn from guys like Jeff and yourself. It's been a great privilege for me to be a part of it. So thank you for letting me have the opportunity. After my conversation with Jeff, I was looking forward to talk to you. And a big part of that, I don't think anybody listening to this is going to need an introduction to who Josh Crumb is, but I think it would make sense perhaps to talk a little bit about Smarter Markets. And on the first time you graced your own podcast, which is always a great thing. I've done that myself on occasion. It's a tricky seat to be in, and you pulled it off beautifully. But I think letting people understand a bit about what it was that made you start Smarter Markets, what the idea is behind it, and what Smarter Markets really means to you.
Instead of giving my own origin story, I think maybe this is the first time I should give the Smarter Markets origin story. So, funny enough, it goes back to a villa in Southeast Asia. I was there with Robert Friedland, a few years back. And, we got on the conversation of, what's happening in media and financial journalism. And actually, in many ways, inspired by people like yourselves who really brought this sort of alternative media and long form conversation to the finance sphere. I was talking to Robert and a number of his guests about podcasts and about these conversations, and it was funny enough. Robert actually hadn't listened to a podcast before, and so he gave, which is not, because Robert perpetually lives 10 years into the future, right? So and he hands me his Apple iPhone, and of some of you that may know Robert's background, actually he had a lot of influence on Steve Jobs. So, and that in itself was, again, there was sort of an irony to all of this. And so the first episode I download for him is the Edward Snowden conversation with Joe Rogan. And he proceeds to disappear for about 3 hours, right? And I think most of his guests probably didn't like that. But that was the origin story of Smarter Markets, and we started talking about it, and we said look, we should do a podcast. And this was actually the first podcast that Robert was ever on, was our first episode. And then the first podcast that Jeff Curry was ever on was our third episode. And since then, we've also sort of broken some ice with a number of CEOs and C-suites that have never done the long form conversation before. So for me, anyone that knows me and I guess knows me even as a CEO, I am terrible at sound bites. I'm much better, or not, I wouldn't say better, but I'm much more into having long form conversations and trying to tease out these issues. And I think specifically what we're looking at, in these big challenges that Jeff also started off his podcast talking about inequality, talking about the energy transition, and how do we solve these big questions, that really doesn't work with sound bites. These are very, very big challenges that need very smart people to kind of tease things out and to do things, and kind of open source their brains to the world. So, that's really what Smarter Markets is about. And yet again, I had no soundbite, but this is where I want to go with Smarter Markets.
I think you're right. I mean, you and I have had several of those long form conversations over the years. And I think having flexibility and allowing yourself the time to, as you say, tease these things out, it's just a great way to do it. I think the podcast audience is self-selecting. The people that actually have the time and the inclination to listen to long form conversations just revel in podcasts, because it's tough to get that sort of stuff anywhere else but podcasts these days.
Absolutely. And look, and don't get me wrong, I love listening to also very good analytical, podcasts. S&P Platts has a number of them that are really, very good analysts that are very well prepared and go through, facts and figures. And I think that's also very, very valuable and something that really didn't, exist much, that long ago. So, I think the medium and this availability of information is absolutely incredible for the people that want to dig and find things. One other one that I really liked, a number of years back, I started watching some of the early YouTube episodes of blitzscaling with Reid Hoffman. And, it was really, you'd have a YouTube with 100 views and you get 2-hour long form conversation with Eric Schmidt while he was the CEO of Google at the time. And so I started, putting my Wall Street, analyst hat on. And I was like, so, most of Wall Street's analyzing sound bites and, very scripted and prepared PRs. And yet here's this 2-hour conversation about the history of Google and where he thought the real key strategies and things happened. And I think that's pretty incredible that's out there right now. And we just wanted to, because we have access to a number of, very interesting people in the projects that we're working on, that's really what we wanted to dive into.
Yeah, fantastic. I think you guys did a great job with it. I spoke recently with Jeff Curry, and as always, it was just a fascinating conversation. Jeff's mind is just phenomenal when it comes to the commodity space. A lot of what we talked about was the energy transition. So I want to start with you with a pretty broad question, but I think it makes sense to define this, because for a lot of people, they struggle to put this into real terms. So just for people listening, how would you personally, Josh, frame what the energy transition is all about?
That's a great question. And that's, again, one of the keys of Smarter Markets is about asking big questions rather than sort of projecting answers. Because, I think David Greeley, who hosted a number of excellent series recently, in the first interview, where he was the guest, because, we do mix it up a lot, he described it as, do you really want to change the engine, while the airplane is still flying, or do you want to plan things out and do it later? The big question is there such thing as an energy transition? If you think about, the path of energy sources and fuel sources as the Industrial Revolution grew, typically we brought on new energy sources, but we never really, other than maybe, whale oil, we didn't really ever shrink demand, or, we just added new energies to the mix. So that's the big question, is can we do it this time? And how do we do it? Do we need mostly offsets and sinks? Or can we actually, decline, carbon production without resulting in energy poverty and so forth? So, that is the big question that we want to keep working out on, and it's going to take many, many years to work out.
Well, obviously, one of the big components of this particular transition is the urgency with which it's being mandated now, and the penalties that are being discussed if we don't get this. So that it's a little different to have an energy transition with a gun to people's heads.
Absolutely. And yeah, like you said, the gun to somebody's head, I think some of the first approaches was just, finding the choke points in the energy system and try to, cut them off, pipelines or passes or, and that sort of thing. And then on the financial side, you had sort of absolute mandates for divestiture, just cut, institutional shareholding of anyone that owns anything that's, quote unquote, dirty. And I think that's going to turn out to be again, very problematic as well. So where I am hopeful, though, is over the last, probably year and a half, maybe 2 years, there really has been a very big study and a big internal change in the way a lot of companies are going about this. And I would even say, there was a big wake up, of course, with the energy shocks in Europe and Asia in late 2021 here, that maybe absolute divestiture is not the right path, because then you start hitting real energy security issues. So this is an evolving conversation, and of course there's the sort of again the gun to somebody's head on one side, but there's also the we don't want to freeze in winter, or we don't want to limit fertilizer production because people will starve. So I think both of those realities are now on the table, and it was sort of always one or the other. And I think that's actually what's going to make 2022 so fascinating as we, again, keep evolving this analysis and this conversation.
That's interesting. You've set me up perfectly for my follow-up question with that, which is we've seen an enormous push from governments, particularly on very public podiums. COP26 was the most recent one. And we've seen governments talking tough and wanting to send very positive, very inclusive, very progressive messages about climate change and about this switch to cleaner energy. But we've also seen, as you say, we've seen a period now of rampant inflation in relation to what it's been like for the last 25, 30, 40 years. And we've seen governments start to make the kind of decisions that you and I, as guys who believe in free markets, almost expect of them at all the wrong points in time. So do you think that this unfortunate timing that we have this inflationary pulse now coming through that really is hitting the energy markets extremely hard, which obviously bleeds through into food markets, the two places that governments can't afford for there to be meaningful inflation. What does this do to their desire on the one hand to really push forward with new green agendas all around the world versus trying to stay in office in the next election when people are struggling to feed their families?
Yeah, look, it's a great question. I think Jeff actually had a great answer that, that at the end of the day, the politicians are going to, reflect the conversations of their populace. So, and I think that urgency, after, more or less, 5 or 6 years of pretty cheap energy prices, that wasn't as urgent as some of these other issues. But, I think it'll be a big tell even in the U.S. Midterm elections later this year. How much has that really shifted some of the, I guess, more, extreme measures that were coming through government the last few years. So I think it's a big question. But, one thing that I think that Jeff maybe didn't touch on enough is just how much the actual, the energy industry has really taken the charge on this conversation. And not just the energy industry, but the whole manufacturing supply chain. And ultimately, these companies are global. And so they are looking at customer demand and stakeholder demand on a global scale that I think many of the politicians obviously are not accountable to, elected overseas. So they, you could have a very progressive idea about labor in one place, but then sit there and criticize, exporting of jobs to poor people in other countries. In itself is a little bit illogical, but if you look at what their actual incentives are, they're not going to get any votes in those third world countries, right? So I think having the global perspective of industry is what's so fascinating over the last 2 years. Is I actually think that industry has taken the lead on climate change, and governments right now are kind of in the back seat. So that'll be actually interesting to see how they react to that.
Just kind of following that thread, it's something I'm curious to get your thoughts on, and that is central banks. Central banks have seemingly taken up the gauntlet here and decided that they are going to be partly responsible for solving climate change. What do you make of that? What do you think, practically speaking, they can do, if anything? And is the fact that they're starting to make this one of their main talking points deflection, or is there genuinely something that central banks can do to contribute to the climate change discussion?
First off, if you look at someone like Mark Carney, who's really taken the lead in, I guess, the sort of global financial initiatives in, net zero policies and scaling carbon markets, he came from that sort of global central bank, where he was also sort of working on, became sort of a global central banker working on, shared problems across the central banks. So I think part of it stems from that. Actual individual peer networks that are probably involved in similar conversations. But I think the second part of it probably comes from, and again, this is all sort of off the cuff speculation, but I would say another part of it comes from probably a view that they had a lot more bond buying tools and that they might have them for an extended period of time through the great stagnation or something like that. I think the fact that inflation has caught so many of them off guard, I think where their policy tools probably existed to influence this was, again, buying more, say, ESG friendly bonds. And I don't see that on the table anytime soon. So it's hard to say where that'll come from other than, kind of general forward guidance and being part of the macroeconomic, narrative.
Well, listen, I want to change gears a little bit because, the one thing I don't want us to do, you and I, is cover kind of similar ground to Jeff. I want to broaden out the conversation. And part of that is something that you guys did really, really well on Smarter Markets, and that is some of the conversations that seemed tangential to what you were looking to do, but ended up being actually some of the best discussions you had. And that's things like privacy, digital identity, and obviously there's been all sorts of advances in these spaces, which we can come on to shortly. But talk a little bit about why you broadened out Smarter Markets to topics such as privacy and digital identity, and how you see those relating to what you set out to achieve.
We got that question a lot when we first introduced Michelle. And in fact, we spent a lot of time debating internally whether these are two separate podcasts. And, would we risk user engagement by switching back and forth between the subjects? So I guess I'll get to some of my thinking on how these two topics actually converge, and where we think the topics of DeFi and energy transition funding start to converge. But first, it would be good to step back and talk a little bit about market information in general and how the evolution of trading markets is constantly evolving with the advances in information technology. If we go back to Economics 101, one of the first assumptions in a simplified supply and demand curve is perfect information. And we all know that information isn't perfect and data is very messy, but getting more abundant, ever more complex part of our global economy. So in 2021 was especially fascinating when we really started to see the power of social media and call it populist politics start having, really an impact on markets in a powerful way, more powerful than perhaps ever before. Which, going back to some of the things that Jeff said about populist politics, the markets themselves are perhaps having, an increasing role to play when this kind of information enters the market in more transparent and more efficient ways with, the most, voices and the most, sort of dollars possible. And so, back to the intent of the podcast, we think it's important to talk about and try to tackle the important questions in markets, but the market information itself. But it will increasingly be important for traders and market participants to have a view on, the structure of information in the market, and how this data and information moves to ultimately match, some, marginal supply and marginal demand. So we want to keep exploring, emerging new information technology on the horizon, and we'll continue to have conversations about, open source software revolution and Web3, self-sovereign identity and its role in, digital title transfer and, lowering costs and increasing trust, for market participants. But even some of the big underlying data issues of privacy and data governance. So putting my Abaxx CEO hat on, looking at Abaxx specifically being a new innovative company entering, the land of giants in commodity trading and infotech, we believe we are doing some innovative things. And our corporate philosophy is to open source a lot of the big ideas and big challenges, as we talk about, the big questions as we advance our way through them. There's an old adage in mining that on average, it's not until the seventh explorer or developer of a porphyry deposit, with some of the large, copper gold deposits, it's not till the seventh explorer developer that actually makes money on it. Typically 6 juniors or exploration programs, shuffled somewhere in the outer regions, typically fail, but they slowly increase the knowledge of the geology and the subsurface over time. And the extraordinary complex project engineering, gets study and, how to get the ore out of the ground. But each developer moves the dream forward and lowers the information entropy and, the uncertainty, for getting that copper, into the world and increasing the capacity of our electricity grids. Each one moves us forward a little bit. And, that's the point of always trying to open source more and more of this information. Abaxx is here, plain and simple, to solve big problems as entrepreneurs and capitalists. And we want to move the world forward no matter what along the way. And this podcast is part of it, letting the market vote on the information quality and the ideas and get that real-time feedback as we work through them. That's just, my personal view of how to solve a big problem and build a great business. So I guess, getting back to your question, I do think capitalizing the energy transition, with the hard capital and capitalizing, the information and the software, systems of Web 2 and Web 3, the revolutions, we're currently living in, we do think they're linked. And that's been on my radar for many years as being linked. If you look at 2021, I would say one of the big stories, or maybe the biggest story, if we look back in retrospect, 10 years later, who knows? But I think one thing was, of course, the rise of DeFi, of decentralized finance, and the NFT market, and a number of things that were happening in the blockchain ecosystem. And I think the interest for me is that, can some of these new technology revolutions, really accelerate and provide a different path than the traditional, debt and equity capital markets? If there's one soundbite I'd take away from 2021 is, that it might be the year that the efficient market hypothesis, officially died, right? With some of the prices that we saw and everything else. And again, this is sort of, college dorm room conversation stuff here. It's stuff I think we're all trying to work out right now. But, one of the questions I've been asking or thinking about it in terms of the asset class of a token in DeFi or an NFT is, have we actually moved to a stage of, for many years, capital markets, we're really just driven by debt, right? And for the most part, like, that's still the core of the global financial system, of course, our debt capital markets. But really what we saw is this rise of, the limited liability company and equities, and particularly over the last, couple generations, equities have featured more and more prominent. But one of the questions I've been asking is there such thing? Do we move from limited liability to sort of no liability companies or no liability assets? And why would something have value if it's not a liability? And really, I think the answer is in network effects. We talk a lot about externalities from a negative standpoint, negative environmental externalities, but there's also positive externalities in pooling liquidity and in sort of net information network effects. Again, I'm not saying that this time is different. I think, Grant, you and I probably come from similar sort of, value investor schools of thoughts that, this time is never different. But there is a new technology that sort of extend this ability of having assets with network effects beyond the typical capital structure. And I think that might be, something that's just starting.
I guess the question is around pricing and how you value those network effects, because at the moment, there's a huge premium being put on every network simply because they can tag it with network effect. And I wonder, having seen what we've seen in the last year, again, there seem to be an awful lot of threads coming together here. And if the pressure on rates to go up continues, it's going to be very, very interesting to see how a lot of these speculative assets that are really in the very early innings of what I'm sure will be a very long game. But we could find a lot of these network effects getting re-rated in terms of price.
Oh, absolutely. And I think, although we try to, produce these conversations that aren't so specific in time, but, if you've seen any, the last few weeks, we've seen that in markets, right? We've seen a big divergence between, network effect companies with actual business moats and profits really diverging from ones that have great top line revenue growth because of their network effects, but actually have not proven to be profitable businesses. And again, I think the very outer risk of that limited liability to no liability assets, of course, are going to be, sort of pure token type networks.
The idea of profitability strikes me because when Jeff was talking about this transition and how to tax carbon effectively, it was clear that profitability in the commodity sector has always been extremely important, right? I mean, that's always been the thing that has made and broken companies. They've not tended to have too much runway when they weren't making money. A lot has happened in the last couple of years for the commodity producers to get their balance sheets in shape, get themselves into a much better position. Does the kind of extra push towards ESG, does that present another hurdle for them, or do you think a lot of these commodity companies have already taken the kind of steps that will allow them to move pretty seamlessly as the regulation increases?
Yeah, well, again, I think the last, call it 18 months, there has been a change in these companies and looking at other metrics. But that said, there's a big argument to be made that we need these companies to be profitable. And in many ways, one of the big problems in Europe and Asia this year, it seems to be, a little bit politically, polarized, whether you're, pro green energy or not. But at the end of the day, there's many factors. At the end of the day, the energy companies had very low return on capital for many years. That also influenced their lack of supply growth this year. So it wasn't just green infrastructure. So, I think absolutely they need to be profitable. But, one of the things that I think is a little bit dangerous is we also want to try to make a lot of these companies something that they're not. I think, if you want to focus on energy security, we need these companies to be investing in what they're good at, while other companies are doing the heavy lifting in innovation and alternative energies. One example is someone like Exxon, obviously one of the largest energy producers. And I think something like half of their production plans for 2030 comes from investments that sort of started from, after 2020. So if they just stop investment and don't actually continue those investment cycles in traditional capital, we're going to see a fall off in net energy supply, which again, if you look at the events of ongoing events, but it started late last year, that's very problematic for the world. So one of my friends, Arjun Murthy, who's also on the podcast, and has a fantastic Substack, former equity analyst at Goldman. He mentions or he makes the analogy of Netflix wouldn't be Netflix if it was forced to merge with Blockbuster, right? You don't want Blockbuster, driving the change. There's a natural evolution, and you want these companies really focused on what they're good at. So when you look at something like the energy transition, I think you're right. You want them to be profitable. You want them to be focused on what they're good at, but that doesn't mean there are things, with a change in mindset and a change of culture. One of the big advances on the environmental front the last year was really, the focus on methane. And so if you think about particularly some of the low capital returns of the shale patch, you had both environmental problems and methane leakages as well as low returns, which is sort of a lose-lose situation. But I think that the companies, as they're more profitable, are going to be more focused on cleaning up methane emissions as a big example. And I think there was a lot of progress there. So I guess the short answer is, you want these companies focused on what they're good at, but at the same time being, I guess, probably more aware of some of the negative externalities so they can turn those profits into solving those problems.
Yeah, but, Josh, with that being driven by policymakers, that's a very tricky position for these companies to be in, right? Because look, their natural path of least resistance is to become more efficient, to be able to produce at lower costs. We all know what they're incentivized to do. And the existing environmental rules in a lot of the countries where the resources are primarily extracted from are only getting tighter as time goes by. So they're cleaning up a lot of the problems that we've had, particularly in things like the gold mining space for many, many decades now. Inserting government into that at a time when they're trying to make political capital out of all this, it just, I don't know, and I don't want to harp on the point, but it just seems to me that is going to potentially become extremely problematic for these companies. Yeah,
well, I think it a little bit goes back to the point of they need to be profitable, and that will change a lot of the conversation. So, and again, it'll give them an ability to do more. So if you think about again, one of the more positive trends in my view, away from divestment, right? It was easy to divest a company because it wasn't green if it wasn't making any money either, right? So now we're in a different market. Will people continue to have this major cost of capital divergence, because of certain metrics that may be forced either by some of the large fund management initiatives or by outright government regulations and caps? I think that's a big question that remains to be seen. But I think one thing that has happened, and again, maybe this is a natural reaction from the market that doesn't want to divest in profitable companies, is, hey, let's not look at this as divestment, but let's score people around their improvement, right? So Again, I mentioned Exxon before. That was a combination. The activist board nominations and the change of board from engine number one. That I think that really has changed the culture internally. But again, that was a mix of upset shareholders combined with some of the new policies. So again, it's having these conversations, and I think the market is having a lot of these conversations right now, which is ultimately a good thing.
We are going to take a quick break, and we'll be right back.
We hope you are enjoying What Are Smarter Markets with Grant Williams. Please join us in February for our next series, Demystifying the Carbon Markets, hosted by myself, Dave Greeley, Chief Economist at Abaxx Technologies. Corporate climate pledges went mainstream in 2021 as CEOs and boards of directors responded to increasing pressure from ESG-minded investors, banks, employees, and stakeholders. Moving into 2022, these companies are increasingly focused on developing and implementing plans to turn their climate pledges into climate action, and understanding how carbon markets can help them turn their good intentions into meaningful change. For many, however, carbon markets remain unfamiliar, creating apprehension over the potential risks. They have many questions. What are carbon markets and how do they work? What is a carbon offset and what types of projects produce carbon offsets? How do I judge the quality of these projects? Will the carbon markets be large enough to be liquid and meaningful to all of these net zero goals? In this series, we'll talk with the architects and experienced practitioners of the carbon markets, seeking answers to all these questions and more from the people who know these markets best. You can join the conversation on Twitter at @smarter_markets. And now back to Grant.
Let's come back to Web 3.0 and the tokens we were talking about earlier, because this is, it's sort of endless fascination for me in many, many ways, both the technology and the psychology behind it all. I just find the whole thing fascinating. But one thing's for certain, they are becoming an asset class. There's clear movement in that direction. So how should commodity investors think about these new digital assets as an asset class? What can they bring to that space from their commodity experience that might help them?
Well, that's been an interesting one that's fascinated me for many years. And I know you and I have had a lot of conversations about, Bitcoin and gold, in particular, because if you look at something like Bitcoin, that to me very much is a commodity, right? There's a utility, in the proof of work algorithm and the limited scarcity and the way these trade, that to me performs, like a commodity. It trades like a commodity. I think the ones that are getting more interesting, again, are, things like NFTs or even like an infrastructure blockchain, like Ethereum or Solana, where again, it's sort of a combination of this network effect, but also, the utility that's provided in the blockchain in, creating, security and trust. And so, that in itself, again, that's a positive externality. When you can increase trust in a system, in a market, in a network, that's a positive externality that should have some value, but it's very different value than traditional, profit and loss on the equity line, or, a return of capital or on a debt payment. So I think there's definitely a need for these systems and these assets because of what they can do to sort of organize crowds, organize the wisdoms of the crowd. Ultimately, that's a good development in markets. But, I think the world is very much still trying to figure out how to value these things and how to allocate, capital to these assets.
It's interesting. You talk about crowd trading there, which brings us on to, like the hive trading we've seen in the retail space. What have you seen through your work in that space? Because it's everywhere I look, it's interesting to watch, but tough to figure out whether this is a moment in time or there is really some kind of change happening here.
I believe there is a change, and not that I'm playing a little bit, armchair political economist or something, but I think what you're seeing, of course, is a lot of the political dynamics, moving into the market. And at the end of the day, markets have always had political dynamics, move into them, right? So, you can't isolate one system from another. So, we clearly see a lot of sort of opting out of the current system, a lack of trust in current institutions, and instead, putting investments in these types of assets. I think that's part of it. But I also ultimately think that there is underlying technology that shouldn't be dismissed because of, thinking something like Dogecoin, which started as a joke, became so popular and again was one of the big stories of 2021. Now, if I look at commodities specifically, one of the things that obviously Abaxx has been working on, but where I see this technology being most useful is in digital identity, is in really creating a digital proof that someone is who they say they are, where it's encrypted, it's time-stamped and sealed, and it's secure, but everyone can access that timestamp, and that immutability property becomes very interesting to sort of speed up digital identity. I always ask the question, when the person on the other side of the screen or the text, when it's more probable that they are who they say they are, through digital proofs, than analyzing someone's signature in a court of law, right? And the other mechanisms we had for contract signatures and so forth. It's just going to speed up commerce and speed up trust even faster. We've seen the rise of collaboration tools. I think the stat is something like 45% growth in enterprise businesses of collaboration tools over the last 2 years. And of course, again, one of the companies that was really flying in this last surge was a company like DocuSign, right? And how valuable that digital signature is. But at the end of the day, that's still, that signature that is still stored on a server, held by DocuSign. But when we can start really having open standards and really having, a very, very high probability that, yes, it was Josh that signed this digital document, that can speed up, trust in a commodity supply chain or any business, significantly, and reduce a lot of cost. So again, that's another part that we're focusing on is how we use the utility of these blockchains in a very specific way to increase trust and lower cost.
What's the pace of movement like in that, Josh? Because when you and I first spoke about what you were looking to do, it was fascinating to me, and I've seen the progress you've made. But have you found it heavier going, or has it been actually perhaps smoother or faster than you thought it might be to try and move this adoption along?
I always perpetually think, it's 1 year out or maybe 2 years out. Even though I know the old adage of you overestimate the 5 years and underestimate the 10 years, right? And I think digital identity is going to be, or self-sovereign identity specifically, is going to be another one of these. But I see the signs, and very much like we started building the energy exchange focused on LNG and carbon markets, well before that became the front page news, in fall of 2021. I've been working on that project for 3 or 4 years, expecting this outcome. And I would say, very similarly in the self-sovereign identity space, I started that probably 4.5, 5 years ago. And I think this year, I've started to really see some signs. You look at a number of projects through Microsoft, and now the company formerly Square, Block, and you look at I think Avast just acquired a self-sovereign identity company. So I think this is moving. Now that still probably means that it's probably a couple years out where I'm like, this is the year. But I guess when you see the puzzle pieces falling into place, it does give a lot of hope that that we've been on the right track.
For the benefit of people that aren't familiar with what you've been doing in the LNG market in particular, because that's something that everybody, whether they are interested or not, is kind of being forced to understand a little bit better in recent weeks and months. So talk a little bit about the market, how it functions, and what you guys have been doing, because it really is a tremendous story.
Yeah, absolutely. So, it's really about finding buyer and seller of last resort markets. So when we think about commodity futures exchanges, they're such an important tool in growing the supply and managing a low volatility growth and supply to meet demand. Obviously, nobody likes volatility, right? And so not the consumer, not the producer. The uncertainty is always the problem. So if you can bring more and more information to the market to reduce that uncertainty, it allows people to plan the future a lot better. And we had a particular thesis a few years ago that, there's going to be a number of different, changes in growth and changes in volatility of various commodities because of, this energy transition, right? We would see, I guess eventually, not yet, but eventually probably less need for something like oil trading and a lot more need for, LNG or carbon trading. And so, we've seen the development of, WTI over, many decades now. And really, people forget it's really only been a sort of a decade and a half that Brent crude has been a very prominent global contract, that it sort of took some of the headlines from WTI. And so these commodity markets are always evolving. And we think there's new tools that are needed, for very specific commodities that we're lacking in the current market. So that's really what that side of the business is all about, is risk management. I mean, one of the factors that I think still people just really don't, in the conversations I've had, really don't have their head around is just how big this capital investment is. And it's not really in things that are very well defined right now, right? So we're looking at something, I think my former colleagues at Goldman had a number, something like 56 trillion, needed in capital investment to net zero, which is something like 3 to 4 trillion a year, ramping up to something like 6 trillion a year, which is this is like adding China's to the global economy. Like that's how much capital is going into this, that needs to go into this effort, and in many cases in technologies that are not even yet proven at any sort of industrial scale. So, to me, that's going to need a massive amount of market information. That's going to need a massive amount of risk management tools. And so that's really what we're focused on is, in the digital identity space, is really trying to increase trust and market information. And then, of course, in the benchmark and the exchange space, really looking at tools for risk management, so capital can be, employed, very quickly. And sorry, one more number, just because, as I read, sometimes I see these numbers and I think it's just so important to think about, maybe going back to our conversations on central banking. Actually, many of these companies that will really rely on for this CapEx, they've actually been shrinking their CapEx, and research and development as a function of cash flow for decades. We used to be in the sort of 65% of cash flow was, going back into growth, sort of a secular growth phase of many decades. Now we're probably on the lower half of 50% going back into CapEx and growth. Yet at the same time, just the energy transition CapEx is going to require something like, year over year growth of 3% of global GDP invested right back into the energy transition. So if our net increase is 3% of GDP, and depending on your views of inflation, real growth is probably only 3%. We basically have to invest our entire global growth right back into energy transition. Again, I think those are sort of macro numbers that people still just don't have their head around, and just how big this this challenge is.
Well, it's cursed by the law of large numbers, right? When you're talking about $50+ trillion, it's very difficult for people to get their heads around it. Right? It sounds like one of those made up numbers that kids in playgrounds throw at you. It's very difficult to visualize that and understand what it means on a sort of bottom up level.
I think people are starting to understand, the gravity of this. In fact, I, just today landed after spending a week in the Kingdom of Saudi Arabia. And there was a large conference put on called Future Mineral Summit, and it was absolutely incredible to listening to some of the top officials in government and some of the most important companies in the world like Aramco talking about basically reinvesting out of oil and into minerals and copper and electrification supply chains as part of the the 2030 initiatives. Saudi Arabia is really going all in making these types of investments and thinking about these types of investments. I mean, if you look at some of the keynote speeches and some of the, these are the same conversations we've been having on Smarter Markets. And I can guarantee you, when I was in, Washington, D.C., last year a few times, they weren't having the same types of conversations. So, I think the world is really starting to gear up to make these investments. And, as an investor, I think it's a phenomenal opportunity to be involved in this. This is sort of like, sitting in sitting in Hong Kong in 1995, or Silicon Valley and in the 80s or something. The path ahead here, I think, is just as investors and allocators of capital and engineers and builders, this is an amazing decade and a decade or two to come.
You guys are trying to revolutionize a lot of these energy markets with the way that they're priced. While I think energy producers are incredibly cutting edge in terms of the constant need to improve their technology in the extraction process, the pricing of energy markets has always seemed to me, and you have a much better sense of this, which is why I want to ask you the question, it always seemed to me pretty resistant to change. And it seems there's a lot of ways in which the pricing of natural resources could be so much better. How have you found trying to take that kind of change to those markets? Has it been embraced, or have you had pushbacks from incumbents and people who just have a way of doing things that you just don't want to change the way it's done?
Yeah, there's always an institutional pushback and an inertia. So short answer is it's difficult. and I guess I've been kind of in that sort of trailblazing seat for a long time. And I guess I'm certainly used to taking those punches and things taking much longer than I would like to. But certainly the dialogue is there. I think some of the things that we were saying about pricing externalities, having differential pricing for carbon or ESG, related metrics, I think that was sort of a new idea, sort of a year and a half ago, that our podcast, frankly, I think really helped the zeitgeist and really expanded that conversation. Particularly Robert Friedland's episode and Jeff Curry's. So I've heard that more and more. Even the conversations that we were having in Saudi last week, during this past summit was very similar in that we're just talking about one of the big problems with a commodity, and I talked about a lot of this on the last episode, is fundamentally it's a commodity, right? It's supposed to be interchangeable, and you price the lowest marginal cost, right? But what has that done geopolitically and in our supply chains over the last 20, 30 years? Even if a company is doing better and better in sort of cleaning up their local environment, reinvesting in their local communities, they're still getting priced the marginal, sort of lowest cost incremental supply, coming out of, maybe out of a country that, didn't have the same environmental standards. So in many ways, the resource rent is disappearing for a company that's doing better. And there's no incentive to do better in many ways, unless it's, purely out of charity or regulatory, right? Like that has been a big problem. And again, if we need, particularly the heavy, physical industries to be, reinvesting, literally trillions into cleaning up, they need to have the kind of margins of a Silicon Valley company. So how does that happen? How do we start pricing the margins so these companies can have the capital to perform? And that's been a big part of what we're trying to do with Abaxx and in our markets. And I think that's a lot that we're trying to do on this podcast as well, is to really get that conversation started.
As we kind of move into 2022, paint me a picture, if you can, for the people listening to this, of the major changes that you think are most likely that we need to watch out for, the big shifts that you see in whether it be commodity pricing, energy markets in general, that people need to be paying attention to, over the rest of this year? Yeah,
well, I actually think this year maybe was probably a little bit less sort of new information than last year, right? I think there was a lot of people warning about some of the problems in the energy supply chain, which again became sort of front page news, by November or December in the inflationary talk, and again, like the ideas of differential pricing, and some of the contract work that the LME did, and some of the things that we're working on. I think these are, maybe it's not mainstream from a pure capital markets, but specifically people in commodity industries, I think are really getting used to these. I think the big question, or probably the big new information that's going to come this year again is how do we use some of these technologies, like blockchain, like these crowd swarms, how do we use those to capitalize the energy transition, very much like Tesla, as an example. Like how do we create the Tesla of copper mining, right? And is there a token involved in that? My base case is probably not, but I'm just, again, the point of Smarter Markets is not that I have answers, but we want to ask these questions. And so that maybe is something that we'll start to see, hopefully, is some new technological, and sort of market innovations to really, really accelerate, capital moving to this space.
Listen, one last question before we wrap up, Josh, and that is around the people in the business. It seems to me, with my exposure to the resource space, that there seems to be like a new generation coming through the ranks for the first time, really, in quite some number of years. And there's a lot of very young, very smart guys running resource business now. And it feels to me like we are on the cusp of seeing some real change in that market. Are you seeing a new wave like I am of these dynamic CEOs taking real old world businesses and modernizing them? Or is this another false dawn and the resource sector is going to still remain with people of my generation as opposed to the next generation?
Yeah, I'd say a little bit. I mean, certainly the cultures are changing, but one thing very specifically over the last month or two is just the incredible amount of turnover, and I guess hard to find people in any roles, right? So I'd say that's probably the bigger issue is we're really trying to rethink work and what companies we want to work with. So I'd actually say that's probably the bigger challenge. But yes, that probably is some level of volatility, which will come out the other side in something something different, right? We're kind of going through one of those turbulent phase transitions. So, and certainly more capital and more profits coming to the space will attract more people as well. But, short answer is yes. I think the thinking is a little bit different. I also think one other thing that I guess younger people probably have that I'd say in the sort of the first part of the commodity cycle in the early 2000s, I would actually say most people didn't even believe it, right? The amount of gold companies that didn't believe in their own product, but all of a sudden are phenomenally rich, and didn't really know where it came from, kind of living in those sort of Canadian capital markets and so forth. I think that, a lot of people were really caught off guard. I think this one's a little bit different, and then it's attracting people that are really, working on different challenges. We need to do a podcast series on Saudi Arabia specifically, but probably one of the most shocking things I saw. So, I'm a Colorado School of Mines graduate. There's a lot of Saudi engineers and geologists from the School of Mines. And, I was at the Aramco booth and they were going through a digital core shack. And there's a young Saudi woman that, another Colorado School of Mines grad. And we were, and she was walking me through the digital core shack and the technology, the artificial intelligence and the way it was straight out of Star Trek, moving things around on a big table, and you can pull up screens and look at drill logs, moving squares around with your hands, and it's sort of rendering and processing in real time. The amount of technology that's also going into these sectors, I think, gives me hope. And of course, young engineers or geologists, like that young woman at Aramco, gives me a lot of hope. So, sometimes you can look at these things and these are big, scary problems, but you always, also want to recognize the things that certainly didn't exist 5 years ago.
Thanks for joining me today, Josh, to discuss your approach to making the Smarter Markets vision a reality. Next week, I'll be joined by Eric Townsend of Macro Voices, who will share his thoughts on what's going right and what's going wrong and how Smarter Markets can be part of the solution.
That concludes this week's episode of Smarter Markets by Abaxx. For episode transcripts and additional episode information, including research, editorial, and video content, please visit smartermarkets.media. Smarter Markets is 100% listener-driven, so please help more people discover the podcast by leaving a review on Apple Podcast, Spotify, YouTube, or your favorite podcast platform. Smarter Markets is presented for informational and entertainment